Hi everyone, my name's Darryl Panes, CEO at As Good as Gold Australia, and today once again I'm joined by my brother Brian and partner at As Good as Gold.
Thank you, Darryl.
And today we interview Chief Economist John Adams. Good morning, John.
Good morning, Darryl and Brian. How are you today?
Very well, John. Thank you for that. And there's some exciting times out there. Most people will be looking at dreadful times, but we see at Good as Gold some exciting times. But yes, there are some political problems out there, and we're going to be discussing those today.
I think we're both busy. John, you've just confirmed with us pre this interview that I think we're the fourth interview, and you've got another one to go after this. This is all over a few hours. So John is back with a vengeance. No doubt.
John never left, but he did have. He was tied up on a couple of good ideas that he's working on.
Very important projects.
Yeah.
But he's unleashed now, so seriously back in business. As is the case with us. I mean, we were never held down, of course. We've been busy all of the time, but I've got to say that the last 2 or 3 weeks, I've never seen anything like it. We have been absolutely swamped. And a lot of this new business is coming in from referrals. We're going 10 deep. So Bob would introduce Sam introduces Phil introduces Dorothy introduces Veronica, and so it goes on. So we have never seen a situation like this before. And I am speaking with people within the same building as us at our office complex. They're saying gold and silver. This is just people you meet and walking by in the passageway, and they'll say, gee, you guys must be busy. Well, we're seeing the people coming in at the moment. But everyone is talking gold and silver. It's the go-to asset at the moment. So, and we're experiencing it. So we have been flat out. It's hard to imagine it could get any busier, but I've just got that impression that it's going to be.
Yeah.
Right. So, John, going back last weekend, we had the Australian Prime Minister, of course, and Leader of the Opposition in the Great Debate. And they were asked about inflation and the cost of living. Now, I'd like to know what your main takeaway was from that debate.
The real big lesson about what the Morrison and Albanese said was they have no solution to the cost of living. I mean, they failed to identify the source of the inflationary problem, and the source is while there is some concerns and issues in respect to Russia and the Ukraine and the impact on oil prices and how that flows through to retail petrol prices. Most of the inflation is caused by expansionary monetary policy that's happened during the pandemic, both in Australia and across the world. And basically, they were not willing to talk about the unspeakable thing, which was they printed too much money, and now we have stagflation, and it is a serious issue. I mean, in our last interview, Darryl and Brian, funny enough, we actually recorded on the morning of the release of the CPI, but while we were talking, we were not aware of what the latest CPI number was. So I think in our last interview, we said that official inflation was running at 3.5%. Well, subsequent to our last interview, inflation is now officially at 5.1%. And we know that the CPI is rigged. So when the Australian Bureau of Statistics is saying that inflation's at 5.1%, well, the real rate of inflation is probably 9-10% in terms of what the average Australian is suffering, and we've got the highest level of official inflation in 20 years, and millions of middle class families are struggling with the cost of living, and so that's why they ask this as the first question, because it perhaps is the number one topic that middle class families are in terms of facing. And obviously, even subsequent to that interview, we've had a range of questions about wages And will wages catch up with prices, or will wages continue to drag down? And if that obviously happens, we have negative real wage growth. And again, I think inflation, the cost of living, is going to be a critical determining factor as to what happens in terms of the election, which is only a week and a half away. But when you listen to their policy solutions as to how they're going to address this topic, they're trying to use the budget and taxpayer dollars, whether through additional spending or through potential tax subsidies, to alleviate some of these cost pressures in certain areas, whether it's childcare or petrol prices or the cost of housing. But these are ultimately band-aid solutions to the ultimate and the more fundamental problem is that we have too much debt, the government is spending too much money, and it's being financed by a Reserve Bank of Australia that has just printed, north of $300 billion, and now that's coming into the fore. And funny enough, I just in the last few weeks I did a show with Martin North where we actually played the Deputy Governor of the Reserve Bank of Australia saying to Parliament, who could have foreseen this coming? Well, whether it was me on Martin North in the interest of the people, or whether it was me with As Good as Gold Australia back in 2020, we basically said that the response to COVID was going to lead to an inflationary problem, and we caught it right. Most economists called it wrong, and now the RBA is saying, well, who could have foreseen it? Well, maybe the RBA need to call us up, and we can go to Martin Place in Sydney and provide some of our expertise, because there was a pretty obvious consequence as to what was going to happen. And now a lot of people who haven't positioned themselves appropriately are suffering as a result in terms of their financial position, in terms of potential hardship, and that's obviously an unfortunate position. So, but the real key takeaway is that no matter who becomes Prime Minister after the 21st of May, the problem's not going to go away, because neither one of them or their respective political parties are willing to address the elephant in the room, and the elephant in the room is too much debt, interest rates too low, and I think that phenomenon is going to continue as we move forward.
Yeah, but Scott Morrison keeps telling us, John, that Australia and this government is the envy of the world. I mean, that's the extreme of it all here. We are the envy of the world. He keeps using that expression all the time. You are 100% correct. What is, I find, with reference to debt, everything you've said is correct. But what I find amazing is that governments rarely make reference to debt. They talk about unemployment levels being the best they've been in the last 60 years. They talk about apprenticeships, more apprenticeships at the moment than there have been since 1963. And there may be. I doubt it very much. I mean, I do recall companies such as Holden, Ford, Toyota, Mitsubishi, Kelvinator, so white goods industry, automotive industry. I recall SA Railways. These companies employed thousands of apprentices every year, thousands of apprentices going through the system. Today, not one of those companies exists. So I don't know who's replaced them, Brian.
No.
I don't know who's replaced them. All we hear is that apprenticeships are at an all-time high, or since 1963, and unemployment is at an all-time low. But the interesting thing about that is apprenticeships, just very, very quickly, John, and I'd like your response on this, but with reference to apprenticeships, I can't believe this, but there is governments have been providing incentives for apprenticeships to a maximum of $7,000 a quarter, or $28,000 a year. I wish these deals were around when we were employing apprentices.
We got no incentives there.
We got nothing like that. But if those incentives are correct, and I believe they are, of course, apprenticeships are at a considerable level. But at what cost to the Australian economy? I mean, it's outrageous, John, that they're able to get away with this. Your thoughts?
The only thing I can say is that you've got the Prime Minister and the Treasurer saying that they are running a responsible budget, and the deficit is $78 billion. I mean, and that's just this in terms of next financial year, 2022, 2023, $78 billion deficit, and that's somehow responsible. I mean, so at some point we actually have to balance the budget, and we actually have to start repaying the debt. And if you look at over the forward estimates, and just so our viewers understand, I mean, when the government publishes its numbers and they produce a forecast, it's over the coming 4 years. That's what they call the forward estimates. It's reading for the next 4 years. And unfortunately, if we're going to get to a balanced budget, hard spending cuts have to be done. And the most obvious candidate is the NDIS. I mean, the NDIS is approaching the size of the defence budget. And it was a promise that Labor made that the coalition, for political reasons, could not back away from. And it's just been a financial disaster. But the NDIS is approximately about $25 billion a year, and we just can't afford it. So if I was the treasurer today, I'd be going through all the spending line by line, and I'd be announcing spending cuts of probably about $100 to $150 billion per year in order to balance the budget straight away. But and I've raised this with politicians in the past in Canberra, given that I used to work in federal parliament, and they keep on telling me it's suicide. The Australian people are addicted to government assistance and government handouts, and if any politician was to confront the Australian people and attempt to take that away, that there would be enough outrage and resistance that people would lose office and they couldn't win elections. So, the reason ultimately why we have an ongoing inflation problem, according to the political class, it's not their irresponsibility, it's the moral weakness of the Australian people. And the Australian people are not willing to go without and go through some form of hardship. So while you've got politicians willing to make promises and promise fantasies, and the Australian people want those fantasies and continue to accept them, we're going to have an ongoing inflationary problem over the next 2 or 3 years, and I'm sure we'll come to this. So that's why I'm very optimistic about the direction of precious metals over the next 2 or 3 years in the medium term.
What people have got to understand is that if a company wants to continue to operate over a lengthy period of time, they have to make a profit. So new purchases are made out of profits. This government doesn't know what profit means. This is what they do. They just keep printing this stuff until, Brian, what happens with us, if we kept spending money like that, we'd run out of it, wouldn't we? Right?
Absolutely.
But what do these guys do? They find some more. They find some more. They just print some more. Yep. And that's what's happening in Australia at the moment. And in the process of that happening, Darryl and Brian Panes and the rest of us are paying $2.40 at the moment a litre for fuel. The other day I topped up my tank. It was around half a tank. It was $120. $2.42 per litre. And if we weren't benefiting from this offer or that the government has provided us with at the moment, they've reduced the tax on fuel and pass it on to us, it would be around $2.80 a litre. Not going to be long, John. It'll be $3.80 a litre. And what are they going to do? Just more of that. And unfortunately, they never run out. But what happens, of course, we go from $3.80 a litre to $4.80 a litre to $5.80 a litre, and everyone's going to be complaining about the cost of living. There is, I just don't, but we're the envy of the world. We are the envy of the world. But we've got to keep that in mind.
But we might be riding bicycles instead of driving motor cars.
I'm out of money, Brian. It's your turn.
Yeah. Well, look, we get back to the stage I mentioned in a video the other week, is that the cup of coffee, about 40 years ago would have cost under $1. Now they're $4.50. Guarantee, folks, that if this inflation keeps on going, you'll be paying $8 for a cup of coffee. And your wages do not grow at the same pace. And I'll tell you why they don't grow at the same pace. Because the government doesn't tell you this. Let's say they give you a 10% wage rise. You don't get 10%. You get about 7%. The wages, the actual cost of living goes up 10%, but you get 7%. Why 7%? Because they take 3% in tax. That extra 7% to 10%, They take it from you before you even see it. So the cost of goods go up 10%, but you only get 7%. So every time there's a wage rise, you're a loser, not a winner.
I agree.
John, last week the Reserve Bank of Australia... Oh, another point here. After what you said here, John, I think you should be part of the Reserve Bank board, because you'd be the only economist that would not put up with this crap, right? And you'd put your point of view across, because all the others are Keynesian economists and you are the only one who's not. So I'll let it go at that. Question 2. The Reserve Bank of Australia raised official interest rates for the first time in 11.5 years. Can you explain what was the decision of the RBA and its rationale and its consequences?
So last week, the Reserve Bank board met and raised interest rates by 25 basis points. So the official cash rate went from 0.01 to 0.03%. And like I said in your question, that's the first rate rise in 11.5 years. There was quite a bit of concern about inflation getting out of control. Obviously, as we said before, it's 5.1%. One of the biggest problems with the RBA is their credibility has basically collapsed. Last year, as late as November, the RBA said that rates would not go up until 2024, and a whole host of people entered the property market signing significant mortgages and basically trying to work out what their cash flow obligations were, because they were relying on the statements of the RBA. And so when the RBA says we're going to freeze rates for the next 3 years, people took that to the bank and thinking, well, if I have to pay a certain level of mortgage repayment today, then I should be able to afford that over the next few years, and I've got time to save some money up and have a bit of a buffer. But here we are, about 6 months on from that commitment, with the rates starting to rise, and there was obviously a foreshadowing of additional rate rises coming forward. So here we are in mid-May, and the first Tuesday of June, the RBA board will come back and meet again, and I have no doubt there'll be another rate rise. Some people are saying they could be, 0.25% up to 40 basis points, and this is having a significant impact in terms of mortgage holders in particular, who have enormous sums of debt, and they don't have any buffers to absorb additional interest rate increases. And obviously, the commercial banks have no hesitation to pass on these rate increases, and they did so last week. And if there's a rate rise in June, I have no doubt they will continue to do so. So, obviously, part of the rationale is that we have record low unemployment, we have rising inflation, there's evidence of wages growth, so that's why they want to start tightening interest rates, given that they ended quantitative easing back in February. But then obviously we get into the interesting aspect of the forecast. So you've got Goldman Sachs and ANZ and a few other economists saying that the RBA will increase interest rates 8 times once every month between now and Christmas. And if that was to happen, the RBA governor expressed that the neutral rate, the rate in which the economy will not either expand or contract, is about 2.5%. Now, I have significant reservations that the RBA can take interest rates back to 2.5%. If we think about where we were in 2019, the official cash rate was at 1.5%. And then they obviously lowered it to 0.1 and printed exorbitant sums of money and did quantitative easing, yield curve control, term funding facility, and a range of other measures. Well, because the debt is so much larger, both in the household sector, government and corporates, particularly in the small business sector, I think we will struggle to get back to where we were in 2019, because a lot of people across the economy just won't be able to absorb the interest rates we had back in 2019, let alone going back to 2.5%. So there's a really big question as they start to raise rates, what happens to the economy, what happens to consumption and economic growth, and will they continue to increase interest rates to the extent that they have foreshadowed, or will they reach a point in which they can no longer go forward because basically the housing market and households will become too financially shaky, and then they have to pause and they have to start cutting rates again. So I'm in the camp that I believe that rates will go up. They'll probably pause by the end of the year or early next year, and then they'll start to cut rates again. And that's why we'll have ongoing inflationary problems, in late 2023, early 2024. But there's obviously other people who have a different point of view, and that's the ultimate question for investors. Not only in Australia, but across the world. Will central banks meet the task of inflation, or will they surrender that fight, and inflation will get out of control even more compared to where we are now here in 2022?
Well, yeah, what you're saying, John, and summarise that particular question and answer is that we've brought it up before. Politicians lie, and so does the Reserve Bank people. And I hate to say it, but it is true, because you're right with the raising rates. Wasn't going to happen until 2024. Right now, they've already done their first one. They're talking about another one every month for the rest of the year. These poor, the people that went out and bought the mortgage, had the mortgages, bought homes, mortgages, all on that information. Now they're looking at themselves, well, we've got to have a wage rise, I've just pointed out that your 10% wage rise, and it won't be 10% either, it'll be probably about 5%. But if inflation is running at 8.5 or 9, you are dead in the water. And you've got to remember that 5% wage rise is going to be reduced by taxation. You are totally dead in the water. I think you're underwater. And so I have no time for our politicians and people who work with the central banks, because they don't tell you the truth. Not in my opinion.
Oh no, I think it's in everyone's opinion, pretty much.
Well, they're starting to learn. They're starting to learn. They're starting to doubt the promises. How can they pay for promises? Well, they've just got to print money. That's it.
The only problem with that, Brian, is that those people who are starting to find out, they're the ones who made decisions before them finding out what the real situation is. And so for a lot of middle class families and lower class families who have signed on to mega mortgages, they're suffering at the moment. It's interesting, Darryl, that you say that Morrison says we're the envy of the world, and yet we've got 42% mortgage stress in terms of the country, according to Marta North and Digital Finance Analytics. So if we're so great, how come so many families are struggling financially? The real situation is completely the reverse of what the narrative is coming from the political class.
Yes.
Yeah.
100%.
100%. John, at the beginning of February 2022, you wrote an article about the coming hyperinflation of Australian property. Given that interest rates are going up, which would imply deflation, how can you argue that stagflation and potential hyperinflation is coming to Australia?
So ultimately, in my view, this comes down to politics, not in terms of economics. So what we know from the global financial crisis was that the reason why Lehman Brothers ended up blowing up in September 2008 was because Greenspan and Bernanke raised interest rates too high. Well, initially they took them too low after 9/11 and the war on terror in 2001. So they got down to about 1% in 2004. But then they raised them too high coming into 2006, 2007. And too many American households that over-leveraged themselves basically wasn't able to make their repayments on these subprime mortgages. And that's when the whole house of cards blew up. And obviously it wasn't just the United States, but it was also in the context of Ireland as well. So now as we go forward, they're going to try to raise rates, try to get this inflation problem under control. But then we get to a point in which if they raise interest rates too high, too many households won't be able to meet their repayments. There'll be delinquencies, there'll be foreclosures. And then, if there's a small amount of that, the system can take it. If there's too many, that's when you have a systemic financial crisis that potentially could top the economy into a deep depression, let alone recession. So the question investors have to ask themselves is that, are the elites in Australia and around the world, are they willing to purposely collapse the biggest debt bubble in human history and cause the biggest depression known to human civilization. And my bet on that, if I can use that term, is that they won't. And even, for example, in late March, when the Reserve Bank of Australia was before the Australian Senate taking questions, they said we have no plan to purposely crash the economy. And then only in the last fortnight, when you see US Federal Chairman Jerome Powell, after they raised interest rates and he held a press conference, he said further rate rises are subject to economic conditions or to economic and financial market conditions. And what does that mean? If they raise rates and financial markets become too volatile and shaky, they're going to stop raising rates. And only in the last few days did the US Federal Reserve publish a report about financial stability. And here's the ironic thing. I mean, they've only raised interest rates twice in America. So 0.25%, and the second time 0.5%. And they've already released a report saying they're concerned about liquidity in the financial markets, and that further rate rises may cause systemic problems in the financial system. So because of that, I mean, that's why I will on this occasion credit Peter Schiff. I think Peter Schiff's recent podcasts have been pretty much dead on in the sense that the central banks, in order to overcome the inflation problem, you have to raise interest rates a substantial amount. And obviously, one of the big differences between the world today and the world in the 1970s is that we didn't have as much debt and derivatives and financial risk then compared to what we have now. So, a lot of people have talked about we had, double-digit inflation in the 1970s. Paul Volcker raised interest rates in America up to, close to 20%. And that was able to get the inflation problem under control. Well, because we have so much additional debt and derivatives in the economy today, there is no prospect of us repeating what Volcker did back then, because it would cause, like I said, the biggest financial crisis in the history of economics. And there is just no appetite from politicians or bureaucrats or executives from the banking system. Because you think about it, I mean, a lot of these banks would go under because, and I should say, particularly in Australia, I mean, one of the big differences in the Australian context compared to some of our overseas counterparts is that, the average benchmark for a bank to lend to households and mortgages is about 38%. Well, our banks have lent about 60% of all their loans is in mortgages. So if you raise interest rates too high and the housing market collapses, well, that will basically topple the big four banks. And if those big four banks go, it's going to be a worse depression than 1892. And they basically know that, and they won't allow that to happen. So that's why I think we're going to see rate rises. There will be a pause, and they'll start to cut again. And one of the big things I called out in my article was that while we were in the midst of COVID-19 lockdown and concerns about inflation in the second half of 2021, the prudential regulator, our banking regulator, Australian Prudential Regulation Authority, they released a draft paper in July of 2021, releasing their draft expectations for negative interest rates. And they basically said to the banks, we expect you to be able to not just theoretically handle these, but operationally be able to implement negative interest rates across all of your platforms and products. And so they released draft expectations in July. They published their final expectations in about October last year. And they said by October 2022 at the latest, every bank in Australia has to be in a position to handle negative interest rates. And so why would you think in the midst of COVID mania, in the midst of runaway inflation and rising interest rates, why would the banking regulator actually talk about negative interest rates? And in my mind, that's APRA basically letting the cat out of the bag, in the sense that as we move forward, once we get to this point that they will pause and start to cut again, I think rather than going back to 0.1%, which was the interest rates only up until last week, I think we are likely to see negative interest rates in Australia in 2024, and with an ongoing inflation problem. And that's going to, if we have interest rates in negative territory in terms of official rates, mortgage rates could be a lot lower than what they were last year. So if you think about the average mortgage rate was about 1.9%. we could see mortgage rates at about 1% in a couple of years' time. And given that households borrow on a short-term cash flow basis, if you're only borrowing at 1%, well, that means your repayments are lower, which means that you can borrow more over a 30-year period. And that's where I think there'll be a lot of refinancing, a lot of additional equity being taken out of homes, and a lot of new borrowing by households borrowing at 1%. And that's where I think it's the more likely scenario over the next couple of years. And that all signals to my mind inflation. Particularly if, the polls are suggesting that Anthony Albanese will win the election, particularly if Labor is to come in. Their spending commitments are even though the coalition has been extravagant, the ALP are suggesting that they're willing to spend more money in a few additional areas. So whether you look at the broader macroeconomic context or in terms of the political context, it's all more money printing, more monetary stimulus, more spending by governments, and all of that signals inflation, which I think, at least over the medium term, is the likely direction in terms of where we're headed. Now, the only thing that could potentially counteract that, at least in the domestic context, is that if we see a big surprise on election night and you have a lot of minor party politicians, independents being voted into parliament, and you see less Labor, National Green, and less Liberal, Labor, National or Green parliamentarians, and you have more of these independents and minor party politicians, those people on the crossbench may be able to have enormous influence as to what the powers that be are willing to do in terms of economic policy. But again, even some of these independents, particularly these so-called teal independents, if someone says to them behind closed doors, if we raise interest rates, we're going to basically put potentially hundreds of thousands of people on the streets because they've defaulted on the mortgage. Anytime I talk to a politician, they generally don't have that sort of courage. So that's why I think we're going to have a ongoing inflation problem, and we're likely to see lower mortgage rates and higher property prices in a couple of years' time.
You know what, Darryl? I think if we have the independents, too many of them, I don't mind independent because that's what it's all about, having some people that actually think outside of the square. But it reminds me of how the Italian government works. You see the TV cameras and they're fighting one another because they can't agree on anything. So, and that's what happens when you got everybody thinking outside of the square and they want their own opinion coming into law.
And fairly simply, we can call it that everything's working at the moment, but it's working because it's just staving off the inevitable, isn't it?
That's exactly
that's
right.
really the point.
Yeah.
And so, but it works until it doesn't work.
It doesn't work. Yeah.
And that's when you end up in depressions.
Yeah. I mean, I think John is correct because we've interviewed people like Bill Holter, and basically they're all talking 3 interest rate rises and you're out. It's a bit like 3 strikes and you're out, or 3 interest rates you're out, because they all agree that it's already happening now. The stock market's wobbling, right, and it crashes. Then another interest rate rise and it crashes. So I don't like what I see in front of us, but that's what it is. But we keep on telling people that buy silver and gold, and that's. But
we're the envy of the world, Ryan.
We are the envy of the world.
You've got to keep that firmly in mind.
But we're not an envy of the world as far as buying gold and silver. We have less than 1% buy physical gold and silver, only because the government doesn't like you owning it. Right? It's a competition to the Australian dollar or to the American dollar. Let's move on.
Yes.
And we're going to bring back a little bit on that subject, but I read an article. We all know now there's an election coming in a couple of weeks' time, and everybody's promising the earth, or politicians are anyway, they're promising the earth. But one particular promise really drew my attention, John, with regards to the Labor Party and their idea of becoming a partner with the home buyer by investing up to 40% of the cost of the home. This seems a dangerous move, and again, one that will backfire to the borrower. I would like your comments on this matter.
So the most obvious way, if people want to make housing more affordable, well, collapse the debt bubble, raise interest rates, too high, push the economy into a deep recession, depression, and then housing will be 60%, 70% cheaper than where they are now. And then everyone can basically be able to afford a home in a more fundamentally sound and stable economy. I mean that's the market approach, whether it's libertarian or Austrian economics. I mean, that's the right way to go about doing it. But because they're not willing to do that, they need to come up with all sorts of new gimmicks to make housing more affordable. And so this whole notion that the government is going to be a part owner in a home, I mean, again, what they're effectively doing is using taxpayers' dollars to put a floor under the market. So because basically anytime you introduce a subsidy which is, they're calling it part ownership, but effectively it is a subsidy into the property market, subsidies drive prices higher. And that's obviously what Labor wants to do. Now, obviously, the dangerous part of that is that if Labor gets elected and implements the policy, well, think about it. If the government puts billions of dollars into the property sector and they're part owners in property, well, then the government has a financial interest in the direction of property prices, because if property prices collapse, not only do they have a political problem, they've got a big financial problem because all of these assets they've just acquired have just collapsed in price. So, I mean, if Labor does this, Labor would want to profit from this scheme and obviously come out all financially neutral. So they'll have an incentive to either stabilize house prices or for house prices to go up. And the only way they can do that is with ongoing inflation. So I mean, this policy would only provide further evidence that the powers that be at the RBA, the Treasury, APRA, ASIC, and in terms of the cabinet, is that they are focused on a stagflation policy agenda where property prices go higher. Because otherwise, if depending on how many houses they wish to part own, well, if they own tens of thousands and they all collapse in price, well, the equity that the government has put up basically has just sort of blown up on paper, and there would be a huge financial write-off for the Commonwealth. So again, so how much serious work has the Labor Party done on this? I'm not sure, but no doubt there'll be some bean counters at the Treasury Department and the Finance Department who will call out the financial risks of this, particularly if property prices were to fall. And no doubt, if this is a Labor policy commitment, there'll be some sort of scheme post-election if they win. And the real question will become is, well, how much on the financial hook will the government put themselves on, and how much commercial interest will the government have in property prices continuing to go up?
Yeah. Well, before Darryl takes over, I'll just make one comment to the people who are watching this, and you're in the best position to know it's coming from us and people that have run businesses at a profit. If you're going to invite the government to have part of your home, I would say don't do it. I've never seen a government yet to uncompromise the situation. So do not do it. You're really into trouble if you are.
Yeah, look, I mean, I only see this heading south, this whole exercise, the economy at the moment. I just want to pass a comment here. I remember when you and I purchased a property, our first property, Brian. I know what the deposit was that was required at the time was 20%. Over the years, it was reduced to 10%, then to 5%, and now in some cases it's as low as 2% for new home buyers. Then there's cash payments involved, $20,000, $30,000, as well as only paying a 2% deposit. And now we're talking about government having a 40% ownership just to make things even more attractive, shall we say, and potentially possible. But when you introduce measures as extreme as this, it can only lead to an absolute and total disaster. Simply, you cannot afford the property on that basis, and you should never, ever enter into the contract. But these are the incentives that have been provided just to keep an economy functioning.
Yeah.
I mean, a blind man can see that this is going to end up in absolute, total disaster. John, Dow Jones, down 6% in the last month, 8% in the last 3 months, 11% year to date. S&P down 8.8% in the last month. Its worst month since March 2020, and down 13.8% for the year to date. That's its worst start, and we'd start talking numbers here, its worst start for the year since World War II. Generally recognised, when the US sneezes, and we've referred to this, and the whole world refers to it, Australia and the rest of the world catch a cold. On a side note, Bitcoin is also down 50% since its November peak. So there are markets crashing everywhere. My question to you, John, how do you believe the Dow and the S&P, and consequently the global stock markets, are going to perform over the rest of this year?
When we think about what we've been discussing in this interview about interest rates going up over the next few months. So as interest rates go up, I mean, there's two factors as to why stock prices in particular will fall. One is that, you know, the common sort of valuation technique to value a share is what they call discounted cash flow analysis. And basically you use the official interest rate as your risk-free rate. And the higher the interest rate, the less you project forward earnings, and then those earnings are discounted at a lower rate, and then your stock valuation is lower. So that's number one. Point number two is that there's a lot of asset purchases that have happened across the world, particularly in terms of American shares that have been purchased using margin and using debt. So as interest rates increase, no doubt there'll be a number of institutions and retail investors that will be hit with margin calls, and they'll be forced to liquidate their shares in order to cover their debt and interest rate repayments. So that's why I think in the short term, we're going to see further falls in asset prices, particularly either the more speculative aspects like cryptocurrencies and in terms of the tech stocks, NASDAQ and all of that sort of stuff. And obviously, you know, once we reach, and that phenomenon will continue until we reach this so-called pivot that we just talked about, when the central banks pause and then they start to cut rates again. So, what happens at that point when we start to cut rates again? I mean, that's a very interesting question, because some say, and there is a good sound basis for this, is that if people start to realize that the fight against inflation is going to be lost, or rather going back into cryptocurrencies and shares, a lot more people will start to go into commodities, including gold and silver, and that's when a commodity bull market will really take off. But even in the short term, even though, for example, gold has been down slightly compared to other asset classes, and you look at silver. Silver's been down 16 days in a row. It's been down 13.5% for the last month. There's a whole host of technical indicators coming from the COMEX and the Commitment of Trader reports that suggest that gold and silver is likely to rebound while interest rates are going up. And then as rates start to come back down again, gold and silver should have a very positive outlook over the next 1 to 2 years. So that's why I'm very still bullish about gold and silver, and that's why I'm still here with As Good as Gold. But obviously, for those that have a general diversified portfolio, I think they're going to continue to see losses as rates go up, given that shares and cryptocurrencies and real estate was largely inflated. And when I say inflated to levels never before seen in world history. And obviously that's starting to unwind. So there'll be no doubt a whole host of investors that are suffering losses, and those losses will continue up until the point that the central banks change their policies. And will obviously, once they do change, whether they go back to stock, bonds, and cryptos, or whether they switch to commodities, will be the central question facing investors.
Look, I think at this point of time, gold always recognised as a safe haven investment. Brian and I have been investing in gold for the last 30 years or close enough to. And we compare it we sit down from time to time and we compare it to real estate stocks. And at times you can get rich on the others. But we've got rich slow on gold, haven't we, Brian?
Yeah, absolutely. I can't complain.
It just places you in a very sound, comfortable position. That is acquiring gold. If you can compare it to real estate, and I'd like to do that very, very quickly, because I come across people all of the time who say, wow, even yesterday, the day before, I put forward this argument for gold, and no one's seen it presented this way before. But it's all based on facts, and it's pretty simple. If you had $500,000 worth of gold, and some people would say, well, that's an awful lot. And I say, well, look, we can talk $50,000 in gold. The reason I talk $500,000 in gold is because I'm comparing it to someone who's in the properties, and someone who's in the properties would be in the habit of spending $500,000 more than once. It could be half a dozen times, it could be 10 times, it could be 50 times if they're into property seriously. So let's say you've got that $500,000, you put it under the bed or in a safe place in a vault. And if you look back at how gold has performed over the last 20 years, from 2000 right through till now, it's up 650%, which is close enough to 30% per annum average over that 20-year period. But let's say it only appreciated at 20% per annum. After 5 years, you'd have $1 million in value in your gold deposit. You could, at that point of time, retire. You could liquidate at 20% per annum, which is $200,000 a year, and you'd have more money in your account at the end of that year than you had at the beginning. They are the facts. Over the last 21 years, gold has been up 18 times and down 3 times over that period. Been a wonderful performer. Most people don't know that. They don't know it because mainstream media doesn't talk about it. Governments don't talk about it. Federal Reserve, the RBA don't talk about it for obvious reasons, because it highlights the absolute mismanagement of all economies. So let's look at that just for a second. If we looked at a property, a $500,000 property, and let's say you were lucky enough that it appreciated over a period of 5 years, doubled, it's 20% per annum, which would be a rarity, you would have a property worth $1 million. Rented out, after your outgoings, you'd have something like a $30,000 per year return on that investment. What did I say it was on the gold, Brian? $200,000. Yeah. So 200,000 versus 30,000, I know which one I'd take. So gold in this environment in particular recognises the safe haven investment for the last 5,000 years. It's not going to change in the next 5 years or the next 50 years. It's the place to be right now. So I'm so glad that I came across a gentleman by the name of Peter Daniels, yourself, myself, Brian, and he educated us a long time ago the difference between currency and money, how to save in precious metals, and that's exactly what we've done.
Yeah. Followed it right to the T, and it's done very well. And as I say, I'm not concerned about my financial wealth.
No, in a very safe place.
Yeah.
John, would you like to add anything to that before we close?
There's a whole host of people who have blindly followed the whole mantra of property. And unfortunately, even my nemesis, Christopher Joy, who I debated on national TV back in 2019, is forecasting a fall of property of about 25%. So a whole host of new investors to the property market are likely to see quite a bit of hardship, at least in the immediate to short term. Whereas if people sort of looked at this more objectively and looked at safe haven assets like precious metals, they would likely have a stronger financial position than going deep into debt and betting on the biggest property bubble in Australian history. So, there's a lot to comparing precious metals to different asset classes and to look at historical averages, etc. And the only thing I can say is now, unfortunately for too many people, it's too late. But if people are looking at investment decisions, doing these sort of mathematical calculations before you make your decision to allocate capital would be the wisest thing to do. So you've got a very clear understanding of what the risk return equation is per asset class, and you make the best decision for your circumstances.
Thanks, John.
I'd like to make a comment here,
Sure.
and we're coming nearly to the end. But I've heard many stories. You don't have to, watch too much TV, but you hear many stories of hardship with real estate. People own real estate, the interest rate's going up, and they have to sell, or there's a compromise somewhere. So there's this hardship that comes up quite often, right? I've never known one person that's complained about hardship owning gold and silver.
No, good point.
No, it doesn't come into play. You own gold and silver, physical, in your hand. There's no hardship involved. In fact, I love it. Darryl.
John, thank you so much for your input. Always well received, beautifully researched. We thank you so much for your input again today, John. Thank you. And to our viewers and subscribers who continually support this channel, thank you so much once again. Until next time, stay well, stay focused, and goodbye for now.